In my last video, The Hidden Risks of Index Funds, I outlined some of the risks laying below the surface of index funds. Risks you're taking with your hard-earned money and you don't even know it. One of these risks is the fact that when you buy a share of an index fund, not only are you allocating a portion of your capital to some of the world's best companies, but most of your money is going into companies that you wouldn't want to invest in the first place. Companies like Elevance Health, Chubb Limited, IQVA Holdings, Excel Energy, or Fifth Third Bancorp. So in this video, we're going to go step by step on how to analyze a publicly traded company so that you can invest wisely only in the world's best companies. First, you got to find the companies you're interested in. You can do this by screening stocks for specific criteria. There are tons of different criteria that people use, but the most common are the growth rate of revenues, net income, earnings per share, or free cash flow. For example, you could restrict your potential pool of investments to only companies with revenue growth of at least 10% per year over the last 5 years. This is a common criteria for growth investors. You could also screen based on valuation by eliminating companies based on the price to earnings ratio, price to book, price to sales, and the price to free cash flow measures. For example, you could restrict the stocks to only those with a PE ratio of less than 20. These types of valuation criteria are common for value investors. Another investing strategy that has become very popular over the last few years is dividend investing. You could exclude stocks that offer less than a 3% dividend yield. You can go through and figure out what qualities you'd like to screen on, but I personally screen on the following: return on invested capital of 20% or higher, debt to equity ratio of 60% or lower, revenue and earnings per share growth of at least 10% per year over the last 5 years, a dividend payout ratio of a maximum of 50%, and the Morningstar wide moat rating, and finally at least a 3-star Morningstar rating. Once I input the criteria, I end up with a list of companies. The next step is to quickly review each company to determine if it's a potential candidate for a deep dive investigation. For this, I use a program called Qualtrim. This is the program that Joseph Carlson over there on the Joseph Carlson Show has developed, and I gotta say, it's a great tool. It's the best that I've found for the quick, high-level fundamental analysis that I want to do. It helps me quickly identify the companies that I'm interested in so I can spend my valuable time researching those companies rather than wasting my time on mediocre or even crappy companies. I've already gone through all these companies, and although there are some good companies here, we're going to focus on Visa. Just a heads up though, I already own Visa, so take that for what it's worth, but it's the perfect company to demonstrate all of the steps that I take when I analyze a company because it has a lot going on. I start up at the top to make sure I like the high-level metrics before I spend my time looking into the specifics. Their profit margin is 54%. I'm happy with a 25% net margin, and Visa shows double that, which is an early indicator of a significant competitive advantage. Pair that with a 3% free cash flow yield, which isn't great, but it could be worse. Now let's take a look at valuation. Because of their competitive advantage, they trade at a premium to the market, and they should. A 28 forward PE is rather high, but it ain't the worst. But 14 times book and 17 times sales, on the other hand, is outrageous. You're going to have to pay up if you want to own this stock right now. They're pretty much cash neutral, which is good, but their dividend yield is a paltry 0.75%, half of the S&P 500 yield, and in the realm of the Apples and Microsofts of the world. Another indication that Visa is pricey. Revenue is increasing at 10%. I ignore EBITDA because it's just another way companies and investment companies try to put lipstick on a pig. Net income and earnings per share are also showing strong growth rates over the past 10 years. But the thing that makes me drool is the free cash flow per share is growing at a whopping 25% per year over the last 10 years. This is astronomical. Let's go over to cash and debt. Although they're pretty much in a neutral position in terms of cash on hand versus debt, I'm still wondering why they had to suddenly take on so much debt in 2016 after years of carrying little to no debt. We'll come back to that because we'll have to look at the SEC filings for that. Dividends have been increasing at 18% per year for the past 10 years, and shares outstanding are falling by about 2% per year on average, which is also nice. Now let's take a gander at the profitability metrics. Besides free cash flow per share, return on invested capital is the other metric that I put a lot of weight on. It basically shows you the rate of return that a company generates on average when they make investments into their business. Visa runs in the 20 to 25% range, which means that when they make an investment into the company, they generate a 20 to 25% return on average. Compare that to a weighted average cost of capital in the area of 7.5%, and that means that Visa is creating significant value for the company with their investments. Eventually, this value is going to be reflected in higher revenues, higher profitability, more cash returned to shareholders, and ultimately a higher stock price. As you can see, Visa's margins are solid, and the good news is that their margins have held up in the face of rising expenses. Over the past 10 years, their expenses have increased from approximately $3 billion up to right around $12 billion. The overwhelming driver of expenses are their headcount, which has nearly tripled since 2014. This is definitely a concern that I'll have to keep my eye on, but they've been able to keep all their other expenses in relative check, which has put a floor on their net margins at around 50%. Finally, I like to look at the valuation trends to get an idea of if the stock is cheap, expensive, or in line with historical valuations. On a PE basis, it's slightly higher than it was in 2014. On a price to sales basis, it's definitely more expensive than it has been in the past, going from 11 in 2014 to 17 now. But on a price to book basis, it's much more expensive than it has ever been, going from 5 in 2014 up to 14 currently. All in all, it's definitely expensive, and I'd love to get it quite a bit cheaper, but the price to earnings and price to free cash flow, the two valuation metrics that I place the most weight on, show that it is approximately in line with historical averages. That's it for the preliminary review. 8 to 9 out of 10 companies failed this initial screening for me, and if I still like the company, and I do here with Visa, I'll do a deeper dive on Schwab.com. If you're finding this content valuable, please like this video and subscribe to the channel. It's the easiest and a free way to help me grow this channel if you find the content valuable. I start with the financial statements to see if there's anything that sticks out and needs further investigation. Starting with the income statement, it's pretty straightforward. Revenues are up about $9 billion over the past 5 years, while expenses have increased only $4 billion. This has driven the considerable profitability and earnings expansion that we saw in Qualtrim. The primary driver of the increase in their expenses are their employee-related expenses, which should come as no surprise after we just saw the crazy growth in their headcount over the past 10 years. Nothing else really sticks out here, so over to the balance sheet. At first sight, it's a bit concerning that shareholder equity has stalled over the past 5 years. However, this turns out to be a little misleading because of the large cumulative translation adjustments that you see here. I had no clue what this was for, so I went to the most recent annual report to figure it out. If you've never used the SEC's Edgar filing system, you should familiarize yourself with it. I'll leave the link in the description below. There you'll find many different views and breakouts of the financial statements so that you can figure out what things like these cumulative translation adjustments are. We head to the balance sheet section, and you can see right here that these are for foreign currency adjustments. Visa owns a subsidiary called Visa Europe. For their earnings reports, they have to convert all of Visa Europe's balance sheet accounts from the euro into dollars. If you're not aware, the value of the US dollar has increased significantly over the past 2 years. Because of this, the value of Visa Europe's assets and liabilities have taken a hit in dollar terms. This is how Visa accounts for that adjustment. This is also a good time to point out that it's important to look at the balance sheet as of the most recent quarter. Unlike the income and cash flow statements, the balance sheet is as of a point in time rather than a cumulative summation of what has happened over a certain period. Once we switch over to the quarterly view, you can see that this adjustment has been absorbed and shareholders' equity is up at $40 billion from the $34 billion that we ended 2018 with. This is an increase of 15% over the past 5 years, which is better than nothing, but only translate to approximately 3.2% per year growth, much lower than I'd like. However, let's take a look at arguably the most important line within shareholders' equity, which is retained earnings. Retained earnings has gone from $11 billion in 2018 up to $18 billion in the most recent quarter. That's a 63% increase over the past 5 years, which equates to 10% per year, a robust rate of growth to say the least. Even though retained earnings are growing at a nice clip, I still want to compare the change in assets to the change in liabilities to get a sense of how they've been managing their company over the past 5 years. Assets have increased from $73 billion to $90 billion, driven by an increase in cash, restricted cash, goodwill, and other long-term assets. Half of these other long-term assets consist of growth in what they refer to as client incentives. which is just another way of saying long-term contracts with other institutions and merchants designed to increase payment volumes and product acceptance. On the liability side, they've increased from $38 billion to $52 billion, driven primarily by accrued expenses, long-term debt, and client incentives, which is the offset to the same line item on the asset side. I'm able to pinpoint the driver of the changes on the balance sheet by going to the SEC filings, just like I did for the cumulative translation adjustments earlier. For example, if you recall when we were looking at Qualtrim, we saw that they literally had no debt until the end of 2015. We wanted to know why they took on so much debt at that point in time. Pulling up the Q4 2015 quarterly reports in the SEC's Edgar reporting system and then finding the balance sheet, you'll find that they took on this debt to buy out the joint venture that it had with Visa Europe. Since then, their debt has increased from $16 billion to $20 billion, primarily to finance other acquisitions, buy back shares, and pay out dividends. Although the debt remains very manageable given their profitability and excellent cash flow generation, I'd still like to see the debt start to get paid down over the next several years. If it keeps increasing, it will be a cause of concern for me. You have to realize that in 2016 and 2020, when they took on more debt, interest rates were extremely low. If interest rates stay elevated for many years to come, they will face significantly higher interest in debt servicing costs when they have to roll over their debt. This can hurt their profitability, share buybacks, and dividend safety, and ultimately their share price if they don't start bringing it down over the next couple of years. The final financial statement is the statement of cash flows. Cash flows are arguably the most important metric and is considered the lifeblood of a company for two reasons. First, unlike net income or earnings per share, cash flows are much harder to manipulate and doctor up. The main way to artificially increase cash flows is to take on more and more debt. Second, revenues can be misleading because of how accrual accounting works. Just because you recognize a sale and count the sale as revenue doesn't mean you've received any cash yet. It could be the case that the cash is expected to be paid at a later date, and therefore the revenue you just generated actually flows into accounts receivable, which is cash that still needs to be collected. Here's the problem. Those receivables do you no good when you need to fund your business. Sure, you can sell them to someone to raise some cash, but you'll be taking a 20% plus haircut on the value of those receivables. In other words, the revenues that you booked are not your actual revenues. The true revenues or cash received from your product or service could be 20% or more lower than what the company reports. Without cash flowing in, a company is screwed. It will have to take on more and more debt in order to finance its operations until it eventually goes bankrupt. The first section is the cash from operating activities. This shows you the actual cash that was generated by the day-to-day operations of the company. This is the main generator of cash for pretty much every business. You'll almost always see cash from operating activities as the main generator of cash for a company, while the investing and financing activities are drains on cash. If you come across a company that is consistently generating most of its cash through investing and or financing activities, this is a huge red flag. If there's a lot of cash coming from investing activities, then it means that they're selling their property, their plant or equipment, selling businesses that it owns or has stakes in, or they're drawing down their investment portfolio. If there's a lot of cash coming from financing activities, then it means that they're either selling more shares of stock or they're taking on more debt. Neither of these situations are good signs for a company. Looking at Visa's cash from operating activities, you can see that it's driven by net income, non-cash items, and taxes paid, offset by a reduction in cash under other assets. Given the sheer magnitude of the non-cash items and other assets, two very vague terms, I'm going to head over to the SEC filings to figure out what they are. It turns out that they are different sides of this client incentives thing that Visa is involved in to try to grow their business. As you can see, these two line items pretty much offset each other every year. Therefore, you can ignore those two line items for this analysis, but we'd want to keep an eye on them each quarter to make sure that there aren't any significant differences that would require investigation. It also turns out that the cash taxes paid are a subset of the other non-cash items, and Schwab is just providing this breakout for informational purposes. You can ignore this line item. This leaves us with net income as the overwhelming driver of cash flow from operating activities. It's exactly what we want to see. Moving down to the investing activities section, you can see the main driver are capital expenditures, acquisitions of businesses, and the sales and purchase of investments. You may also notice that the only time that cash flow from investing is highly negative is when they either buy another business or they purchase more investments than they sell or that matures. All of these are common for any large corporation, so everything checks out here. One thing that Warren Buffett mentions as an important part of a good business is that they don't spend a large portion of their revenues on capital expenditures. When I get to this section, I like to calculate this percentage to make sure it's not too high. Using these numbers, Visa only spends 3% of their revenues on capital expenditures. Moving on down to the financing activities section. You'll see that this is the primary drain on the company's cash flow, led by the repurchasing of common stock and dividends paid. You'll also notice that they've been taking on debt, which has added cash to their coffers. Digging through the SEC filings, Visa states that this $7 billion and $3 billion of debt issued is for general corporate purposes. This is very vague, but from the looks of it, they're using the debt to buy back common stock. This may have been a smart business decision the past few years when they could issue debt at 2 to 3%, but with interest rates rising, this arbitrage opportunity is no longer profitable. Because of this, I'd expect buybacks to level off to more normal levels over the next year or two, meaning that they may see less of a benefit on earnings per share due to buybacks going forward. That's it for the deep dive into their financials, and it didn't really turn up much that we didn't already know from the review of their metrics on the Qualtrim app. Let's quickly review what we've learned about Visa. It's growing revenues, free cash flow, net income, and earnings per share above our 10% per year threshold, and free cash flow growth has been off the charts at 25% per year. Although it pays a very small dividend, it's growing its dividend at 18% per year. Profit margins and return on invested capital are great. And they're pretty much cash versus debt neutral, although the growth of their debt is the primary sore spot in their financials and something that I have to keep a close eye on. That and the growth in their headcount, regulatory challenges, and new players in the payment processing industry are the primary risks for this company. My next step is to compare their metrics to their competitors. I do this so that I get some industry benchmarks to compare against. If a company's metrics are outstanding like Visa's are, but so are all their other competitors, then that would suggest that the economics of the industry is driving their results rather than the company really having a durable competitive advantage. Also, there are many times that I think I like a company, then I go compare them to the competitors and I discover that I actually like one of their competitors better. Once again, I use Schwab for this, so let's jump back over there to do the analysis. The first thing I do is pull up the Morningstar Equity Analyst Report, which is free with a Schwab account. Here, you'll find a list of their competitors. In the fundamentals section, you'll see that their profit margins are the best of the group. They have very good return on equity and return on invested capital with much less of a debt load than their competitors. This is a good sign, especially if they can start to bring down their debt load. As far as valuation goes, it's apparent that Visa and MasterCard are very expensive relative to American Express, Discover, and PayPal. The primary reasons for this are that their profitability and growth prospects are much higher than those other three companies. For example, American Express earnings per share has been growing at approximately half the rate of Visa over the past 5 years. Also, I just don't like companies that generate only a 12% net margin and a 7% return on invested capital when I can get a similar, arguably better company generating 50% margins and a 25% return on capital. I'm usually going to pay the higher price for the company that is more profitable. The dividends of all these companies look very safe. The only one that pays a reasonable dividend is Discover, and this is because they're primarily a bank first and a credit card company second. Sure, I'd prefer Visa to pay a 2 to 3% dividend, but my primary objective is to invest in companies that grow quickly and have a strong competitive advantage over its competitors, as these are the companies whose share price outperforms the market over the long term. The dividend is more of a nice to have for me when it comes to picking a company. Your approach may differ. In that case, Discover and PayPal appear to be good companies that are going through some pretty significant dips right now. This could be a great buying opportunity for a good company that pays a nice dividend when it comes to Discover. I haven't done my full research on either of these companies yet, so I can't say for sure, but they are intriguing right now. Moving on to profitability. This is where Visa shines. They're ahead of their competitors on all these profitability metrics. You may notice that both Visa and MasterCard have a negative tangible book value per share. This means that their goodwill and intangible assets, such as their brand, the network effect that supports their credit card acceptance, and usage rates are valued on their balance sheet at more than what their equity is. I must admit that I usually want a company to have enough equity to be able to absorb their intangible assets going to zero, as I consider this just another cushion built into the value of the company. But when you're talking about brands like Visa's, which has a global reach and is used by millions of people every day, and has been so for the past 30 years or more, their intangible assets deserve to be valued highly. And then you can see that Visa is generating the superior profitability and growth prospects versus the competitors while using much less debt relative to their equity, which, as I've mentioned a couple times in this video, is something I strongly weigh in my decision making because the interest rates expected to stay at these elevated levels for longer. A lower debt load should be a nice tailwind for the future. After this review versus the competitors, I think it's clear that Visa is the best company. The only competitor that even comes close to Visa in terms of revenue growth, profitability, and cash flow generation is MasterCard. The reason I like Visa better than MasterCard is primarily due to MasterCard's massive debt load relative to their equity. As I've pointed out in this video, I view a large debt load with this higher for longer interest rate environment to be a potential headwind over the next few years as companies have to refinance their debts at significantly higher interest rates. This could materially impact their profitability. Also, MasterCard's use of significant amounts of debts make its cash flow look better than it really is. Then there's the fact that MasterCard has a lower free cash flow yield, a lower dividend yield, has a worse cash to debt position, and it trades at a much higher valuation than Visa. To me, it's a no-brainer. Visa is just a much better company. Okay, the next step is to dig into the story of the company and start learning about all the aspects of the company that you can't learn from just the financials. I start with the Morningstar Equity Analyst Report because it gives you great information about their view of the company's competitive positioning, earnings, risks, and a fair value estimate. Next, I move to the CFRA report that is also free with a Schwab account. This gives me a second perspective on the company and another valuation that I can compare to Morningstar's fair value estimate. Finally, I go to the most recent 10Q filings by using the SEC's Edgar database lookup tool. I provided a link to this site in the description below. Here, I primarily focus on the business overview section. This gives deep, invaluable information about the company from the perspective of those who actually run the company. This is where you get to learn about the company's strategy, their clients, the solutions that the company offers to their clients, their sales and marketing strategy, who the competitors are and how they compete with them, and of course, a long list of risks. For example, Visa states that Visa is not a financial institution. They do not issue credit cards, extend credit, or set rates or fees for account holders of Visa products, nor do we earn revenues from or bear credit risk with respect to any of these activities. This may surprise some people because without the knowledge of how Visa's network works, they think that they are the ones that extend credit to consumers, which is not true. Visa primarily makes money by being the middleman between multiple financial institutions involved in a single credit card transaction. They charge fees for access to the proprietary processing network where they provide authorization, clearing, and settlement services. They do not bear any risk of consumers not paying their credit card balances whatsoever. That falls on the issuing banks. The last step in any analysis of an investment is your estimate of what a share in the company is worth and a plan for purchasing the shares if you decide this is an investment you want to make. You already have the two estimates from Morningstar and CFRA. These are most likely discounted cash flow models for what that's worth. It's great when those two sources agree somewhat, but there are times when they're really far off. This is why I always run my own discounting model on the price to free cash flow per share. My model gives an intrinsic value of $331 per share, which is higher than where it's currently trading. However, a prudent investor rarely pays full intrinsic value for the stock. It's wise to build in a margin of safety. So with a 15% margin of safety, you'll have to wait for the stock to drop to 282. For a 20% margin of safety, it'll be 265. For a 25% margin of safety, it'll be 248. And for a 30% margin of safety, I'd only be willing to pay $232 per share. Well, I hope you found this video helpful. If you have any questions or comments, please leave them in the comments section below. Also, if you'd like to see an analysis of another stock, plug it into the comments section and I'll do my best to get around to it. Until next time, you all take care and remember, wealth is not only about money and things. Your time and health are just as important, and working to improve all three pillars of wealth is key to being adaptable, resilient, and thriving in life.